So let's just take this illustration out 50 years, and we're saving $10,000 a year because we're trying to save money for our future here, and we're going to start at age 35 and go out 35 years and stop our savings. So we go and purchase the vehicle. We know that the price of the dealer is going to charge us $23,000, but really, if we went and paid cash and we got those cashback incentives, we could get the car, we know, for $19,370. And let's just start the first loan in 4 years. We already number of loans. Let's do 8, and we're going to repay these over 60 months. And the payback rate, the interest rate that we're being charged, well, we know it's not 0%, right? We know it's at least 7. So we'll use 7% because that's the real market rate. And so what happens? Well, we've got $350,000 over here in savings, and we're financing these vehicles over a period of, let's say, 34 years. Now, what's going to happen is, let's make a couple of notes here. What's going to happen is, if we finance this, we're going to end up with $350,000 in our savings. But maybe I can do a little bit better than this, because I'm reading all these personal finance books, these blogs that are out there. I'm listening to these financial experts on the radio and TV shows or whatever, and these gurus are really telling me this is not a good plan. The first thing they're going to see is, hey, look, you're paying all this interest over here to the bank. You got all this savings over here. Man, what are you doing? Get yourself out of this debt. This is ridiculous. Get yourself out of this debt and just pay cash for everything, because you're going to save yourself all this interest cost right here. And you're going to be in a better financial position 20, 30 years from now. So you say, okay. So you listen to your favorite guru. And you pay cash. And so we're going to eliminate... take that out and switch this to account cash. What happens? Well, we start paying cash. This is the classic, what they call the sinking fund method. In simplest form, what happens is we're putting in $10,000 a year. We stopped all our financing. We stopped borrowing money from the bank, and we just started taking money out of our savings to pay for these cars. So what happens is we build up $20,000. We withdraw money to go buy a car, and then we wait another 5 years and we do it again, and we just keep repeating the process. It doesn't matter who it is, who's giving the advice. So we just managed to turn $350,000 into $195,000. Huh. What happened? What these gurus are going to tell you is paying cash saves you an interest expense, an interest cost. That's not true. What happens is you save an interest payment, But time has a value. Usually we think of this in terms of interest rate. That's why banks that's why the whole banking industry exists. Banks figure out how much to charge for the risk that they're taking by lending money out. It's, we have this idea that, cash has no value, and that, that if we pay cash, that it's, better than paying interest to somebody else. The reality is, if we pay cash, there's a real cost for that, and we have to recognize that. Now, can we do a little bit better? What if we went ahead and replaced the money, that instead of using just a strict, saving up money and then knocking it down, what if we at least paid back the money that we took? If we did that, we'd get back to even. Does that put us ahead, though? It moves us in the right direction. And we're back to 350,000, but we were willing to pay the bank, or in some cases we were willing to pay the dealer, the so-called 0% financing, but we're not willing to pay ourselves that rate. Why is someone else worth 7% interest, but we're not worth 7% interest? So let's take a look at what that does. If we pay ourselves the same rate that we were willing to pay the bank, now we're moving some of that. We want to look at some of this money we were able to recover. Now we're moving some of this money over to our side. And we've increased our savings. So it puts us up to 384. Could we do any better? Maybe. If we don't need this money for 5-year stretch, maybe we could lock this up in a bank CD, earn a little bit more interest than a savings account. I went ahead and Googled some of the, what banks are paying. Trying to get a bank to pay you interest on your savings is like, it's like pulling teeth. So your average rates out there are about 1.5. So maybe we can get 1.5% interest on this money, and that actually does a pretty good job. It bumps our savings up by a lot. But are we going to pay tax on this? Yeah. Most of the people I work with are small business owners, freelancers, or they're self-employed in some way. And yeah, a lot of people do fall in the 15% tax bracket, but a lot of people are in the 20, 25 percent. And if you're paying that, what's going to happen is you're going to pay a little bit of tax. But you're still in a good position. So if you went and did this right now, you go down to your bank and you just started doing this right now, you'd be in a much better position than probably most people out there, what most people are doing. Now, what if, this might sound a little crazy, but what if we took out a whole life insurance policy, used custom whole life, and we use that as a way to finance this purchase? Now, I know a lot of financial gurus will tell you that whole life insurance is terrible place to put money, but let's just take a look at it. And a whole life insurance, if we, putting in the same premium dollars as we were saving in our savings account. And the thing about whole life is the cash value buildup is not going to be taxed. So we're going to eliminate that, and we take policy loans. Those aren't taxed either, so we don't have to worry about that. We're going to assume the same financing, 19,370. We're going to finance it at 7%. We're going to switch this to account loan because we're going to start borrowing against the value of our insurance policy. Now, there is a cost of money here, and a loan is going to cost us, in this case, 5%, and the insurance company is going to charge us a margin of 0.65% for the loan. So what ends up happening is we're going to see the insurance this is a custom whole life policy. So the life insurance helps us out a little bit. Now, is there anything else that we can do here? Weddings. When my wife and I got married, we financed our wedding through our life insurance policies. I didn't know this before I got married, but the average cost of a wedding is about $25,000-$30,000, and it's absolutely insane. But I don't understand how people can get married more than once. But hopefully, we're going to do this just one time, and let's repay this over 5 years. And if we were going to go out to the marketplace, what would we expect to pay for interest rate on this loan? Most people are going to do one of a couple of things. Maybe they take out a second mortgage or a HELOC. A lot of times what happens is people will just go into credit card debt. They just start charging it up. Credit card rates, they range between maybe 15% on average, maybe 15%. I've seen them go as high as 20, 23, 24, maybe higher. On average, if we're paying about 17%, that's the market rate for a loan like this if it's unsecured. And this is account loan. What else can we do? Well, we can finance a bunch of stuff. We'll give you just a couple more examples, maybe with smaller loans. Maybe we're financing a large purchase. And something else people like to do, my wife and I like to take vacations. And, those can set you back a couple grand. But, they're worth it. And, we'll keep taking those for as long as we can. So what we see, what do we really get from our insurance policy? Well, we've been able to do all the things that we want to do in life, and we've been growing our cash values, or some people consider this their savings. They grow their savings. We've been growing our savings all this time while still being able to do the things that we want in life. And we pushed this cash value from 2.1 or basically 2.2 million up to, 2.5, $2,502,000 $4,799. So quite a bit of a difference there. And people will look at this and say, "Wow, that looks pretty good," and they start getting focused a lot on the interest rate. So they say, "Man, I see a whole life insurance here. The annual earnings rate here you're showing about 5%. Some cases this is 4%. In this case, we're looking at about an average of about 5%." So, and people say, "Well, man, maybe I know I could do better in the stock market. Can I just do this in an investment account? I have a brokerage account, or maybe in a 401k or something like that." Well, let's take a look at that. The thing is, when people invest money, the way they look at it is, I have $10,000 to invest, and let's say that I make 10% in the market. All right, so what is that? It's going to make me, after a year, I'm going to have $11,000 in my account. But if we think back to, how banks make money, what are we really doing here, right? So if you give a bank, $1, or if you give a bank $100 and they pay you 1% interest, and they turn around and they lend it out to somebody at 6% interest, they're not making 10% or 6% or whatever it is. Why can we do the same thing here? Yeah, so instead of, we could invest this $10,000 in the market and just let the equities do what they do, but we could also borrow this money from our life insurance. We could finance different assets, whether it's real estate, stocks, whatever it is that you want to invest in. We could do that. And is our cost going to be $10,000 if we do that? No, it's going to be whatever the interest cost is, just like with a bank. So in this case, the interest that we're paying on the loan is 5%, margins 0.65. So let's call that, on a $10,000 loan, let's say, our cost is, our out-of-pocket cost is going to be $565. If we make $1,000, or in this case we're making the same 10% interest rate, that's a rate of 76.99%. So really, when we're looking at, what are the minimums on the life insurance versus the maximums of everywhere else? If we invested that money directly into the market, or we bought some other asset with it, that investment is whatever that investment returns. That's what it is. That's all it can ever be. But if we put it through our life insurance policy and we start financing those asset purchases, what's the minimum on our life insurance? We start looking at these things. Here is if we think about this in a conventional way, we start thinking about 4%, 5% annual earnings. That's kind of the maximum of what that thing can do. But with life insurance, because we can borrow against the value of our policy, this becomes the minimum of what we can do, because we're still making this annual rate regardless of the loan activity, and that's why we're being able to accumulate our account value the way we did. So isn't the minimum really $2.2 million in this example? What's the maximum? What can we do with the money that we have sitting in our policy? How far can we take this thing?